Last quarter, Google made $119 billion in revenue. It grew 24%. Its cloud business grew 82%. And it still ended the quarter with negative $5.9 billion of free cash flow. The first time that has happened in nearly 20 years. Now, most of the coverage you saw called that a buying opportunity, a wobble, a dip. I want to show you why I think that read misses the actual thing that changed this week, and why the number that matters most is not on Google's income statement at all. Let's start at the scene of the crime. Thursday, July 23rd. In one trading session, the 7 largest technology companies in the world lost $797 billion in market value. As a group, they fell 4.8%. That was their worst single day since the tariff panic of April 2025. Tesla fell 13%, its worst intraday drop in over a year. Google fell 7.3% to its lowest level since April. Amazon lost 5%. Meta, 4.7%. Microsoft, 3.1%. And here is the part that should stop you. Not one of these companies missed on demand. Google beat revenue estimates. Its cloud business is growing at 82% a year. Elon Musk stood in front of investors and told them 2026 is going to be, quote, a massive capital expenditure year. And the market took 13% off his stock while he was saying it. So, what actually happened? For about 3 years, there was a rule in this market that never broke. If you were a big technology company and you announced you were spending more on artificial intelligence, your stock went up. Spending was not a cost. Spending was the bull case. It was proof you were going to win. Every earnings call was a competition to announce a bigger number than the last guy. And investors paid for it every single time. On Thursday, that stopped. The companies that announced the biggest numbers got hit the hardest. The rule inverted. And the question is why it inverted in that particular week. Here is the number almost every write-up buried. Alphabet's free cash flow last quarter was negative $5.9 billion. Free cash flow is simple. It is the cash a business has left over after it pays to run itself and pays for whatever it is building. It is the money that funds buybacks, dividends, acquisitions, and the next round of investment. For nearly 20 years, Google has been one of the great cash machines in the history of capitalism. It has printed this number positive quarter after quarter after quarter. And last quarter, it went negative. Not because the business shrank, because it spent $44.9 billion in 3 months on infrastructure, and then told everyone the full year number is going up to somewhere between $195 and $205 billion. Sit with that combination for a second. Revenue up 24%, cloud up 82%, free cash flow negative. This is not a company in trouble. This is a company that has quietly changed what kind of company it is. Except, and this is the turn, negative free cash flow on its own is not necessarily alarming. Companies outinvest their cash flow all the time when they are building something valuable. Railroads did it. Telecoms did it. Amazon did it for years, and it worked out extremely well for anyone who held on. What makes this different is what happened to the other side of the equation in the exact same week. Because when a company spends more than it earns, it has to fund the gap. And the price of funding that gap is the interest rate. In the same week that Google reported negative free cash flow, the probability that the Federal Reserve raises interest rates in September went from under 53% to 82%. Read that again, because it is genuinely strange. For most of the last 2 years, the entire market conversation was about when the cuts arrive. How many? How fast? How soon? In 1 week, futures flipped from pricing cuts to pricing an increase at 82% odds. Even for the meeting next Tuesday and Wednesday, where a hold is still the base case, roughly 1 in 3 is betting on a hike. Why did that happen? Because June's inflation report was not as good as everybody celebrated. Headline inflation came in at 3.5%, down from 4.2%, and markets loved it. But look at where it came from. Energy prices fell 5.7% in a single month, the biggest 1-month drop since April 2020. Core inflation, which strips out food and energy and tells you what is actually happening underneath, was completely flat on the month, sitting at 2.6% annually. So the good news was essentially one thing: cheap oil. And then, in July, American forces ran 13 straight nights of strikes on Iran. Houthi fighters hit 2 Saudi tankers in the Red Sea. Traffic through the Strait of Hormuz was disrupted, and Brent crude went to $100 a barrel. The exact input that produced June's beautiful number went into reverse. And the new Federal Reserve chair is on record saying prices are too high. The disinflation was borrowed, and the oil market asked for it back. So here is the mechanism, and it is the whole thesis. The artificial intelligence buildout was standing on 2 legs. The first leg was that the companies doing the building had so much free cash flow they could fund it out of pocket, with no financing risk at all. The second leg was that money was getting cheaper, which meant the future profits from all that spending were worth more today, and any borrowing to bridge the gap was cheap. This week, both legs broke at once. Google's free cash flow went negative, so leg 1 is gone at the biggest spender. And rate expectations flipped from cuts to an 82% chance of a hike, so leg 2 is going the wrong way. That is why I do not think Thursday was a mood swing. A mood swing is when the facts stay the same and people feel differently. Here, the facts changed. The market stopped treating capital spending as a signal of future dominance and started treating it as a claim on cash. That is a re-rating, and re-ratings do not resolve in a week. And now the kicker, because this is where it gets genuinely interesting. In that very same week, Intel reported revenue of $16.13 billion, up 25.4%. That is its fastest growth since 2011. It beat estimates by nearly 12%. Its data center and artificial intelligence division grew 59%. Earnings came in at 42 cents against 22 expected, and it was the 7th straight quarter the company beat its own guidance. So on the same theme, in the same week, the buyer got punished and the seller got paid. That is not a contradiction. It is arithmetic. Capital spending is an expense on the spender's income statement and revenue on the supplier's. Every dollar Google is being punished for committing shows up as an order at somebody who makes chips, builds racks, lays fiber, or sells power. So when the market marks down the check writers, the money does not leave the theme. It moves down the stack to whoever cashes the checks. That is what a rotation looks like from the inside, and it almost never gets called a rotation while it is happening. It gets called a crash. Now the honest risk, because I would rather tell you where this thesis is weak than pretend it isn't. Everything I just laid out is priced off oil. On Friday, Brent fell about 4% to settle near $97, its biggest one-day drop since late June, on nothing more than conflicting reports about stalled talks. If oil keeps sliding, headline inflation cools by itself. That 82% hike probability collapses, the discount rate story reverses, and the second leg gets rebuilt. In that world, the dip buyers are right, and I am early and wrong. The other honest caveat is that negative free cash flow for one quarter can absolutely be a timing artifact of when capacity gets delivered rather than a permanent state. If it flips back positive in 2 quarters, this was a scare, not a regime. That is a falsifiable call, and I have put it on the record. So where does that leave the read? Nothing about artificial intelligence demand got worse this week. Google's cloud grew 82%. Intel's data center revenue grew 59%. The demand is real. What changed is the price of the money that pays for it, and who carries the risk of the build. And when that changes, the winners change, even if the story stays the same. So here is what I actually want to know from you. Is the market finally asking the right question about artificial intelligence spending, which is who earns a return on all of this? Or is this just a rate tantrum wearing a technology logo? Tell me in the comments. I'm Frankie. This is the Asymmetric Signal. One contrarian read a day. Subscribe. Research and educational only, never financial advice.